Hey, everybody. Welcome back to the show. Like I said in the introduction, I'm super excited to be sitting down with Blake King, the power markets engineer at Galaxy. Blake, welcome to the show.
Thanks, Ben. Thanks for having me on. There's like been 3 or 4 different people that have recommended me to come on your podcast. So I'm extremely happy to be here. I've heard good things and excited for the next hour or so.
Wow, that's way to just throw me off right out of the gate, Blake. I'm like blushing and super flattered. That's that's awesome to hear. I started the podcast, not that long ago as a way to just nerd out and have these types of conversations, and it's been a lot of fun as we go, but super flattering to hear that people are recommending, people like yourself to come on the show. It's great.
Well, there's a missing space in the podcast world that mixes the Bitcoin mining with traditional energy, right? There's a lot of traditional energy folks that have a lot of good insight that could merge with the Bitcoin mining world. And so I think your podcast is on a good trajectory to merge those. And so happy to be a part of it, even if it's early.
Oh, thank you. Yeah, I likewise, I kind of thought, as you look at the space, you say, okay, Bitcoin mining uses a lot of power. What's the most controllable aspect of the operation? It's your power cost, and the best way to reduce that is to get as close to the power source as possible. So anyways, I ended up at the conclusion of I need to talk to people in the energy industry. Like that's who I need to talk to. So kind of brings me to your title, Blake. You're going to have to explain to me a power market engineer. What is it?
Sure. So I'll start kind of with my background. So I studied electrical engineering in college, and electrical engineering is a pretty broad field. You've got everything from integrated circuits to, basically as the smallest level all the way up to the largest machines, which are, power grids. So I studied electrical engineering with a focus on power. And I graduated and eventually ended up right after graduating working at ERCOT. So ERCOT is the grid operator for the state of Texas. You've had folks from ERCOT online, giving them some airtime, which I was happy to see. I'm basically familiarizing myself with power markets from like a modeling perspective. So worked there for a few years, spent time also at a national lab doing power research, kind of in an academic position. And then also moved from there into renewable development. So I actually worked at a solar developer, which is effectively a company that goes from buying land options through to equipment procurement, doing analysis on the grid at how to build solar farms, where to build them in the most optimal place. And so I was working at the solar developer doing kind of transmission and interconnection and studies, and kept on bringing up Bitcoin as a way to improve our facilities. We should do these co-locations with Bitcoin mining. And they eventually pushed me into a more business development role where I was tasked with kind of research and development on doing these co-locations, whether that's Bitcoin mining, the hydrogen, but like doing it with hydrogen, ammonia co-locations, concrete, all sorts of different kind of commodities that are co-located. So I did that for 6 or 7 months until I eventually decided to go over into the Bitcoin mining world itself. So my mentor and kind of boss now, Austin Storms, is the director of Bitcoin mining operations here at Galaxy. He pulled me over, said, we had been talking ever since he was at Great American Mining about doing some sort of solar co-location. And he said, hey, we're opening up a spot for someone to do power at Galaxy, So there hadn't really been a role like that before, but there's obviously some need to have someone that understands, the ERCOT market, bilateral agreements, things of that nature. And so he pulled me in, and that's basically been my scope. So I work closely with him and some other key folks on the team to do all things power, be that, negotiating contracts or, long-term strategy, short-term strategy, et cetera. And so that's kind of my broad scope. And that's a power markets engineer for you.
All right. What I love about that is that we're seeing people like yourself enter into the Bitcoin mining space, because I think the more that we're able to talk the language of the energy industry, the easier that this is going to be. Whereas I think just even a couple of years ago, 3, 4, 5 years ago, the conversation was cheap power, cheap power, cheap power, and like tons of power. and now it's more dynamic. So that's fantastic to hear. Maybe Blake, what are some common PPA structures that you're seeing? We can just kind of jump right into the
sure.
nerdy stuff here. Like, what common structures are you seeing, or maybe what do you want to see in a PPA?
So one of the questions, so I guess I've got a starting question for you, which is, is this a PPA with a generator directly, or do you mean kind of a broader sense of power contracts with different suppliers? Because there's a good distinction there, and I can go into both if you want, but which one would you like to start with?
Let's maybe do direct with the generator.
Got it.
Yeah, let's maybe start there.
So that one's a little bit more complicated. So those deals are extremely bespoke. Candidly, I haven't seen many contract structures that share a lot of the same attributes, but at the same time, we're starting to form some sort of natural agreement. Now, normally, what a traditional agreement with a generator would look like would be some sort of fixed price PPA, right? Like that's like the standard model that people think of when they think of contracts with generators. And I'd say that the more interesting models that I've seen come now are these kind of floating price co-located structures where the Bitcoin miner is going behind the generator's meter, and the generator, instead of giving a fixed price to the Bitcoin mine, is allowing the Bitcoin mine to pay the nodal price or some sort of other floating price that the generator would otherwise receive from the grid operator. And so you might ask, like, what's the benefit there if it's the same price?
Yeah.
Well, the idea is that there's normally some sort of curtailment saving, right? If you're a solar farm and you've got 10% curtailment, if you bring a Bitcoin miner behind the meter, that Bitcoin miner is now going to be paying you, and you're going to stay online instead of go off. And so normally that floating structure has kind of a floor. So in ERCOT, how solar farms or wind farms are curtailed is ERCOT sends a price signal to that specific node, and that price goes below the offer curve of the unit. So if you're a solar farm, you usually offer at 0. So in order for ERCOT to curtail you, they put the price at -1. And so now you've got an option, right? You can either stay online and pay the negative price, or you can turn off. So in this scenario, Bitcoin miner would kind of co-locate behind the meter. And, when the price is 0, instead of ERCOT paying the solar farm 0, the Bitcoin miner would pay the solar farm 0. And then at -1, potentially the Bitcoin miner would still pay 0, or would still pay some floor, right? So the solar farm doesn't have to curtail. And that's kind of an interesting structure that I'm seeing with co-located generators.
Oh, it's fascinating. And I think this starts to get more dynamic and complicated if you are talking about a wind or solar generator with this type of contract, because I think you're also, this is a kind of a checking question, you're also going to need some type of power arrangement that's on grid, because you don't want you don't want a 40% uptime. Like that's
That's right. Your podcast with Dan Roberts from Iris was really great at the way that he kind of teed this up and illustrated this concept, which is that the capacity factors on these intermittent resources aren't very high, right? Yeah. It's something like 30% at the top end for solar and 50% at the top end for wind. And this kind of brings up this real clash between objectives and incentives, which is if you're a 100 megawatt wind farm, sometimes when you're curtailed all the way to 0, right? And so if you're looking at a Bitcoin miner to help you with that curtailment, of course you want the Bitcoin miner to be 100 megawatts because you want to be able to put all of your energy to them. But the bigger that the Bitcoin mine is, or any sort of co-located load, the more that you're going to have to pull from the grid during the inverse of those hours. So it's really a push and a pull here on sizing. And yeah, you're right. The inverse is difficult because you still have to have the same, infrastructure to pull from the grid. You still have to have the same agreement with some power supplier to get you power from the grid, and you still have to hedge that. That's another part of it, right? If you're co-located, exactly. There's not many inverse wind hedges that are very good out there. So there's also that kind of risk to take into consideration.
Wow. Yeah. It's well, so maybe this is a good point since we're kind of on the we just jumped headfirst into like renewables and power contracts with generators. The narrative that you hear a lot is, well, Bitcoin mining is going to come in and not only fix the grid but smooth out renewables. Maybe talk to me, since we just talked about like a 40% capacity or the load factor, right?
I
And
call it capacity factor, but there's all
capacity
sorts
factor.
of jargon.
You got like a 40% capacity factor at that generator. So, like, how is Bitcoin mining coming in and helping these renewables? Is it really just like a monetizing downtime standpoint, or are there other benefits?
No, I mean, I think that's the steelman. If you want to start with the steelman, and a lot of Bitcoin mining, proponents go very strong on this, we're monetizing renewables, we're helping. The steelman is really that there is a base buyer of last resort or first resort for this energy. And so the best way that I illustrate this problem, and again, it's not as clear cut as some Bitcoin proponents make it out to be, but I still think that there's value here, and it's worth championing, which is that when I worked in the solar development world, right, we would basically you hunt for these good locations to put a solar farm, right?
Okay.
And you find one, and you run some analysis, and you find that if you develop and build a solar farm here, you are going to have decent pricing, but maybe you have 10% curtailment. And so what that means is, right, you've modeled out all of the energy that you sell, so you've got kind of the solar shape, and you've got a model of every day of the year. 10% of that energy is going to be thrown away, just zero, right? And what we in the solar world would do is, we'd have a benchmark. We say, okay, if curtailment is above this factor, we kill the project, right? Because the only way to make that project pencil and financeable is that we have to sell the power forward. And if we've got 10% curtailment, that means that we've got to raise our PPA strike by 10%. So that makes the project less marketable, right? So to make up for that lost energy, we got to increase the cost on all the other energy, et cetera, and we kill the project. So the interesting thing is that these low value hours, or these curtailed hours, the power is so cheap that if there were just simply $1 instead of zero, right, or $7 instead of zero, then that project would pencil and it would get built, it would be created, right? And so the question is, well, if Bitcoin mining, or the idea is, if Bitcoin mining or hydrogen or ammonia can come online, eat up only those low value hours, right? Because this is the very important part, is that in order to like kind of steelman this idea, this co-located load, or just load on the grid, doesn't have to be co-located, couldn't be firm, right? Because if it was firm, then and it never curtailed or responded to high pricing, then you would have all sorts of problems on the grid during these off hours. But if it's price sensitive, then it would eat up all of these low value hours and then turn off when the price of power goes up. So you've basically still got the renewables producing when the price is high, and then instead of having to be curtailed, you've got some buyer of last resort. So if I paint that picture, right, with all of those qualifiers and nuances, then you can say, Bitcoin mining, hydrogen, ammonia, flexible load generally is great for renewables, because we can select when we're going to be buying the power, and then we cannot be firm, so we still don't push the peak of the grid up. And so that's kind of the steelman, right?
So I love the nuance, and that's why I like these types of conversations, because you can pull that out. It's not how many characters do you get in a tweet? It's like 160 words or some shit like that.
The tweets are bad.
It's clickbaity and all sorts of nonsense on Twitter, all in like an echo chamber, which is hilarious to me.
You're either on one side or the other. I had this problem when I worked at the solar development, because some huge name Bitcoin person on Twitter would say something bad about solar, and I'd have to come in and I'd try and give these pros, and of course I'm not about this, and I just get trashed on Twitter. And it's like, okay, maybe I won't, maybe I'll do this in the DMs with people that seem actually interested, and not try and post on Twitter public.
it's a tough world out there, that's for sure. It's a dog eat dog world in the Bitcoin Twitter ecosystem. Get on board with the narrative or get out.
Yeah.
It's too bad, but hopefully we can correct some of it.
Yeah.
Um,
And I will say, like, just to tie up that point, because I know I talked a lot, but I still didn't get around to like tying it together, right? Imagine if you're that solar farm that reduces their curtailment from 10% to zero by this Bitcoin miner that's offline during every hour when power is above $100, you now get to sell your PPA for 10% cheaper than you otherwise would, right? And so this is also kind of the explanation for how Bitcoin mining could cheapen power for other folks, right? Is the PPA from this solar farm is going to make its way to a wholesale power procurer who's going to sell it to a retail electric provider that's going to make its way down there. And it's all because we're now monetizing that wasted electricity and allowing that solar company to not inject that waste into their power price that makes its way ultimately to consumers. And so that's kind of the ultimate steel man that sounds complicated and doesn't fit on a postcard or a tweet.
yeah, yeah. There was another thread in there that I wanted to pull on when it comes to renewables, and I'm blanking. Maybe it'll come back to me as we carry on in the conversation. The renewable stuff I'm fascinated by it just because it's I'm up in Minnesota and just recently had the chance to sit down with the vice chair at the Minnesota Public Utility Commission, and we had a great conversation. And Minnesota's made this charge ahead. We're going to be carbon free by 2040. I mean, there's a huge push for renewables, and it's just okay. So here's where I was going to go with this is
Got it.
so renewables being the big push. Everyone's very focused on it. Bitcoin
Yes.
mining can really step in some of these unique ways that we just talked about. I mean, we still need to have baseload in there, right? I mean, we can't go after the grid with 100% renewable, or can we?
I mean, that's a good question. That's a question that lots of people are trying to answer, and everyone seems to be talking their book. I mean, renewables people love to say that it's 100%, possible for 100% renewable served load. One thing is for certain is that in a world where the grid is 100% renewable, there is tons of overbuilding capacity, right? There's just so much excess wind and solar nameplate, right? I mean, you would need nameplate hundreds of gigawatts of wind and solar that's all being curtailed at various times and basically throwing that excess energy away in order to meet a 60 gigawatt instantaneous demand. So it's possible, but it would require a lot of overbuild, and traditionally that would end up with a lot of wasted electricity a lot of the time, right? And so that's kind of where flexible load, flexible compute starting to enter the picture, where it's like, well, we don't have to waste all this electricity from the overbuild of renewables. I also think there's going to be thermal generation for a long time, for decades. Whether, like, how often, what the capacity factor of those units are is up for question. I foresee a world where there's plenty of coal and plenty of natural gas on the system, but it's kind of maintained as part of like an insurance scheme, right? Where maybe it doesn't operate all that much, but when it does operate, it comes through in a big way. I think that's kind of a more pragmatic and realistic way that we're ending up as renewables continue to pour on, even though they throw energy away a lot of the time.
Sure. Yeah. It's going to be interesting to see what the mix looks like and how people approach it. Lots of groups on both sides of the argument of what the energy industry is going to look like. Well, we're less than 20 years away from that carbon neutral target, so it's going to be interesting. Go ahead.
No, well, I was also going to say it's very interesting for me as well, because the stated goal of these renewables, this whole drive and the whole REC kind of scheme, is to reduce fossil use, right? Like the whole entire idea behind REX is that one renewable energy credit is 1 MWh of renewable energy, and that is supposed to have displaced 1 MWh of fossil generation, right? And so it's basically the stated goal of increasing renewables on the grid is to decrease fossil fuel usage and fossil fuel plants. And so it's always interesting to me and paradoxical whenever I see, like, ERCOT just came out with this capacity RFP where they're looking for these retired or mothballed thermal units to come back online. They basically say, there's a reliability risk for winter. We're looking for capacity that's not otherwise in the offer stack. What capacity is that? Well, it's capacity that's either retired or it's been seasonally mothballed. Can we bring that online? It's just kind of funny. It's not funny. It's tragic in a way that, the stated goal is to retire these thermals, and then sometime later, after you've got gigawatts of solar coming online successfully and wind coming online successfully, it's still like, okay, maybe we need to trace back and actually bring these fossil plants back. It's just kind of ironic.
Very, very ironic. Maybe, Blake, if you don't mind, I actually want to bring you kind of like all the way back to your experience at ERCOT.
Sure.
You mentioned that you were like modeling, ERCOT, and then also your time at the renewable company that you were working at. You said that you were, maybe we'll start at the renewable company, is you said that you were pushing for Bitcoin mining. Like, you got to a point where you were pushing for Bitcoin mining.
Yes.
With these build outs, what were you seeing that they didn't see to start making that push? Like, what was the light bulb moment for you when you were looking at all this?
Oh, it was definitely the difficulty adjustment of Bitcoin mining. So that was the key principle that I tried to foist onto anyone that I could foist it onto, which was this difficulty adjustment, and that if we structured the co-located agreement properly, both sides could be profitable. Like, basically, if we can bring the cost basis of this Bitcoin miner down low enough, even for a short enough time frame, then the miner themselves will always be profitable compared to the network, right? Like, if we can offer this Bitcoin, the network difficulty adjustment will readjust, and we'll have a more rewarding counterparty. And that was basically what I tried to push, compared to hydrogen or any sort of co-located concrete or things like that, along with the fact that you got to sell the product instantaneously. Like, you don't have to create the Bitcoin and then store it or transport it and offtake it and have counterparty risk with the offtaker. You just immediately liquidate the Bitcoin outside of production. And so, and that was the problem, or the solution that I saw, that I tried to push. The problem, and I think it's a problem that persists for many generators or traditional energy players, is the counterparty or credit risk that they face when trying to do business with the Bitcoin miners. There's just not many companies with a big balance sheet that do Bitcoin mining that are willing to post collateral or have investment grade ratings or things like that. And so energy companies who are used to these very thin margins, very high investment grade counterparties, look at this and say, it's just not the risk to do all of this work up front just to end up with what could potentially end up as a bankrupt counterparty on the next Bitcoin downturn. And I think that's just going to be part of the industry maturing, and having Bitcoin miners come through at the other side as more creditworthy counterparties in this industry.
Yeah. So the credit requirements, because I've heard that before, is that it generally takes a lot of capital to come in for as collateral, and that's a normal piece for other industry with these, like with when you're trying to get deals signed for energy, like that collateral's just normal, right? That's
Yep. Okay. That's right. Especially new build renewables. I mean, if you're looking to sign off take, because think about it like this, like my old company, right? We were developing these solar farms, these wind farms. Part of the piece to get a successful project is to sell forward your production, right? And so when you're selling forward your production, you're selling it forward for normally like 15 years, 10 to 15 years.
Oh,
and there's a counterparty on the other side that's facing you on that. They've run the math. right? They've run the math on all of the renewable energy credits that come along with that 15-year term, and they've got their own kind of speculative angle on the renewable energy credits in year 2030 that they're playing. And there's usually cross-posted credit, right? Because now you've got to take this PPA that you've signed with this off-taker to the bank, literally, and get financing for your project. And so the industry is very used to this kind of high standard for credit when doing these long-term projects. And that's why, the structure that I kind of laid out earlier with the, instead of the fixed price, the floating pass-through, that model can actually be layered onto an existing PPA, right? So you can do that while the solar farm also faces someone else for their PPA, and that's kind of what makes the model more interesting. Is that it's basically purely accretive to the renewable and their off taker, right? You're simply reducing the curtailment, which is producing more energy and producing more renewable energy credits, and you're improving any sort of basis, which is a kind of a complicated topic that we can get into if we want, but it's pure accretion to the project.
Cool. I appreciate you touching on that, because I think I have had some discussions where it maybe has felt unfair, the credit requirements and the collateral requirements. So it is refreshing to hear that no, that's just kind of standard, and that's maybe the just kind of industry norm for that type of a thing.
Yeah, the more, and I used to believe that as well, frankly. I used to think that it was,
Sure.
kind of demonizing of the Bitcoin mining industry. But the more that I've kind of looked under the hood in, ERCOT specifically, on kind of the credit risks that some parties take, it makes sense. It makes a lot of sense that there's, a lot of collateral to be posted for certain deals, because what you end up, and I kind of say this like, it's like that meme with the Scooby-Doo, where they're taking the monster and they remove its mask, right? And like, so
Yeah.
what I've got in my head is there's the monster, and on the front of it is like, power pricing risk, and then you take off the mask and it's just credit and counterparty risk. It's like everyone, the more I look, everyone has counterparty risk to everyone else. And the truth about Bitcoin mining is that it consumes a lot of power. So there's a lot of power, and there's a lot of credit and collateral to be posted because of that power
Yeah.
consumption. You just can't really get away from that.
Yeah, I'd be curious for you to touch on what you're seeing as far as like relationships. So maybe starting, what would be kind of fun is like take your experience prior to being in the industry, the Bitcoin mining industry. Like, what were the relationships between generator and Bitcoin miner, and then now what are you seeing? Is that changing? Maybe just touch on the relationship between the two.
Oh, I mean, that's tough. I think, well, before I came to Galaxy, which is going on about a year and a half now, I don't think there had been that many deals struck with renewables and co-located Bitcoin miners. It was still pretty early days. So any sort of structures that I was hearing about back then was very much still on this kind of fixed price paradigm, where someone wanted a fixed price from the Bitcoin miner. And again, we got into that problem where it was like, only for the solar hours. So then you've got to buy from the grid during these other hours. It just kind of doesn't pencil really. So people were still really trying to figure out how to make the deal rewarding for both sides and make value for both sides. I think now we're getting more to a point where there's kind of a mutual level of respect on, okay, how can I make this worthwhile for you, and also, receive value myself, and kind of measure the counterparty risk. So I think we're still kind of getting towards generators understanding the Bitcoin mining model and really how to leverage that difficulty adjustment and things like that. But we're much better in a place than where I used to be, or where we used to be when I was working in that industry.
Well, that's encouraging. So it sounds like it's getting friendlier. I don't even know if friendly is the right term. Was it ever contentious? Was it ever?
I wouldn't say contentious. I would say the attitude back then was more like, I don't want to touch Bitcoin mining. It's a dirty word. The minute that I say that we're co-located with a Bitcoin miner, our stock's going to crash and people are going to just see how reckless this is. I think what's happened is, you know, the Bitcoin miners that are still interested in these deals have persisted through a downturn, right? And so it's kind of showing that there's an attitude toward risk management and hedging your Bitcoin kind of risk that's lending itself to better conversations with these counterparties is what I'm seeing.
Yeah. I think so too. I think also, I mean, even just like this podcast, like I'm able to, get discussions with ERCOT and Georgia, Public Service Commission, Minnesota Public Utility Commission. Like, I think the wind has changed where people are curious. I don't know if everyone is jumping on it. We all want the generators to be excited about it, but at least they're curious about it now.
Yeah, and I'd say you got to remember too that Bitcoin is really just kind of the tip of the spear on this price sensitive load, right? There's a bunch of hydrogen and ammonia and things like this that are coming onto the grid as well, or at least have threatened to come online, is what I say, with all of the IRA money that's being pushed into hydrogen. So, I think that also lends itself to generators looking at Bitcoin mining as part of a broader opportunity of this flexible co-located load. And they're looking at it and they're saying, yeah, maybe we start with this Bitcoin miner, and if something happens, we can always bring in a data center AI company or a hydrogen company that just lands on the concrete pads. So I think that kind of de-risks the relationship a little bit.
Sure. Okay, so I have to ask. I know absolutely nothing about you're mentioning hydrogen and ammonia and some of these other things. What are those as far as like high power off-taker options for like a utility company or a generator?
Like what are they?
I don't even know what it is.
Generally?
Like, so hydrogen, what are they doing? I'm not even sure I know what they're doing.
Oh goodness. So let me think about this. So
taking you way out of your element. Maybe,
yeah, generally, I'll stay high level here because it's been a while since I touched on this. So basically, hydrogen and ammonia, specifically ammonia, is a very carbon intensive process, right? And so is hydrogen, the way that they make it now. And basically, as part of this, net zero trend towards net zero, decarbonizing heavy industry has seen we need to decarbonize the production of ammonia and hydrogen. We need to find a way to do these without such a carbon intensive process, because that's how they're done now. And so the kind of the way that's done now, and I'll stick with hydrogen, or the way that it's contemplated to be done in the future, is basically electrolysis. So you've got a bunch of electrolyzers, basically split the hydrogen and the oxygen from a water, and then you do things with the hydrogen, like you can do heat. You can push the hydrogen into a thermal generator and burn it and make electricity. And so everything in this, there's a lot of incentives in the Inflation Reduction Act to incentivize the production of this green hydrogen. So basically, the existing process right now for hydrogen using carbon is like, say, $3 a kilogram. And you'll have to excuse my specific terms. I haven't been around much. But there's subsidies now that make the renewable hydrogen basically at parity, or maybe even a little bit better than the traditional process. So there's a lot of this green hydrogen coming onto the grid, which is basically like if you take Bitcoin mining containers and instead of ASICs inside of the containers, you swap it with electrolysis machines, and then just every once in a while have a truck come and pull this pressurized hydrogen out and ship it somewhere else. And so they're apparently flexible as well, so you can like ramp them up and down. And they're coming in a big way. So that's kind of the other load that's coming onto the system, is this hydrogen.
Well, first of all, thank you. I've got a bunch of stuff.
Now you're going to have a hydrogen guy on.
Yeah, I've got a new rabbit hole I got to go down. Thank you for that. Joking aside, though, I don't know how it could be flexible if there's a large demand for like heating homes with how are you gonna that be an intermittent load?
I guess that's the midstream, right? So this is the upstream, right, where maybe you're pumping into a pipeline, or maybe you're not, or maybe you've got offtake that comes in the form of a pressurized vehicle, things like it's the electrolyzers themselves that are apparently flexible.
Got it. Okay. So I think what I'd love to hear you maybe touch on a little bit is when you look at like the landscape for this is super nuanced, so hang in there with me. But
Yeah.
when you look at like how the energy landscape is moving and the transition, the energy transition that we're trying to have in the US, and then you layer in like the Bitcoin mining landscape, hash rates at, it's just absolutely ripping. It's just face melting. The network hash rate is just crazy. How, like, what do you see the relationship looking like between energy producers and Bitcoin miners in like 2, 5, 10 years?
Yeah, I think it's this buyer of last resort. I think that's where we get to. I think right now Bitcoin mining is kind of a competitor to traditional demand, right? Like Bitcoin miners have pretty high uptime,
Yeah.
right? We're buying power up to, $100 a megawatt hour, sometimes even the mid 100s depending on the mining model. And, there's a lot of other sources of demand on the market that have their price pushed up significantly in that range. Whereas I believe, with the coming halvings, what you're going to see is this kind of downward pressure on hash price. You're going to see uptime for Bitcoin miners go down, and you're going to see more coordination between Bitcoin mining and grid operators, between Bitcoin mining and their respective, retail electricity providers or their respective co-located generators. And it's all going to come down to Bitcoin mining being really this, consumer of power as a last resort or as a first resort if there's no demand on the system. And I'm hoping that we're getting toward a place where the coordination with the grid operator is more upfront, and kind of more of an important piece of the coordination, I guess.
I appreciate that. Do you think that takes the form of like an energy trading desk at the mining companies, or is it more seats and positions like yours where you're maybe basically plugged in with the energy companies? I guess what do you think about that? How does that look?
In a way, I think eventually we're going to get to a world where mining is really only profitable off spot prices, right? Off of those 15-minute intervals, where price is extremely cheap. I mean, maybe you could buy power forward under certain situations in order to provide other services. I do think there's a little bit of power trading or power hedging, as I like to call it, that goes in like the short to medium term, because it's basically a way, Bitcoin mining is basically a way to underwrite, a long hedge, right? Like you can get into a long hedge of power by mining Bitcoin and then have like a call option on the upside, which is a very interesting model. And it's a model that a lot of public companies have come out and said, we've got a very low electricity cost because we can sell power back to the grid. Like that's basically in a nutshell what's going on. And I don't know how long that model is going to last with all of the halvings that continue to persist, year after year. We're going to have considerable Bitcoin price appreciation for that kind of model to persist in any meaningful way into the future.
Yeah, I agree. It's going to be super interesting because you don't want to sit around with a business model that's like, well, I hope the Bitcoin price goes up.
That's
Not a,
yeah. I
yeah.
mean, candidly, that's how I feel about miners and regulated utilities, right? I mean, I know that there's nuance here because once you get to a specific size, if you're in a regulated utility, you can really work with the utility provider to to get to a deal that's I've invested tens of millions of dollars into this facility. I know that we can make something work. It's beneficial to both parties. But for those smaller or mid-sized miners that don't have the political leverage, you're basically at the behest of that utility, right? It's whatever rate, whatever commercial and industrial rate they've got. And I'm not sure what kind of future exists where that's a rewarding model. Because, like you said, you're basically either hoping that the Bitcoin price goes up so that you can earn enough revenue to cover the fee, or you're leaning on your political leverage with the utility to get a beneficial rate. Whereas in these markets like ERCOT or where there's a spot price of electricity and all these renewables, there's almost
Hmm.
always going to be an hour of the day where there's too much, right? You don't really have to lean on these regulated utilities to provide you with something.
Yeah. Again, being up in Minnesota, was having a discussion, I think it was earlier today, And, the discussion was all around like the regulated power markets don't really know what to do with the flexible load. Like they're trying to pigeonhole it into these, pre-cut rate structures, and it's really not maybe benefiting the grid as much as it could, while also not giving an advantageous enough power rate on the other end. So it's this weird spot with regulated markets.
Yeah, it's tough. I agree with that 100%. I'm not sure if regulated markets are really the place for this kind of experimentation. I could be wrong. I'm happy to be proven wrong. And I think it's certainly possible in the right area with the right utility. But, compared to, what ERCOT is doing with the large flexible loads, and it's a better spot to be in my opinion, in a deregulated market where there's a spot price and there's lots of opportunity to curtail your facility.
Do you know, Blake, is it possible to take like MISO and make it deregulated, or maybe that's not the right way to ask that question. Maybe is there ever a future where Xcel Energy in Minnesota is deregulated? Or
yeah, certainly. Yeah. I mean, every deregulated utility was once a more regulated utility, I will say, not necessarily to the same extent that certain vertically integrated kind of smaller utilities are. But there is a world in which, I think Xcel is probably part of MISO, right? And so they participate in the wholesale market to some degree. It's more a question of how do they pass on that exposure to actual buyers of electricity, right? Do they pass on that exposure via their regulated tariff, or do they pass it on and access to some of the more flexible programs?
I think I need to spend more time kind of better understanding how my own market works, because I've also heard, so we've got this small site down in southern Minnesota. It's a company called Bit49. They have it's maybe 10 to 15 megawatts at a municipal power company. And I believe that municipal power company has the ability to go out and buy like spot power, or somehow Bit49 has the ability to go and buy power on the spot market. So I think that I just need to understand my own market better.
and Ben, let me tell you, that is a Herculean task. It is very difficult to source the information, find the right people. And this is why companies like power brokers are so useful on occasion, is because they are dealing with these folks every day and can get you the right information. It is often very tough to find, how can I do this? Is it something like this? Can you guys do it? And often what you'll see is, if your municipality can buy power at the wholesale rate, there might not even be someone in that municipality that knows that, right? Because, they have their set business model, they know how they do things. And so while they might have an option to do something, they haven't exercised that ever. And so when you come to them and you're trying to tell them something, it's going to be easy for them to just shut you down and be like, that's not something we do. So you kind of have to be tactful and kind of strategic, and lean on your relationships with kind of like key individuals, like actual key individuals in these organizations, to kind of investigate what's possible.
Yeah, I think that's probably what I'm running into, is they may be aware of it as an option, but it's not something they're doing. And so their default is to be like, yeah, we don't do that. Here's our structures, and here's where, you could probably fall in based on the load that you want. And yeah.
And take your pick, and maybe, hopefully not, but it might tie back to the credit piece. Like they might, it's like, sure, we can buy power at a wholesale rate and then sleeve it to you. That's the jargon, is they buy the power at this price, then they sleeve you that cost. But maybe if they did that, they would have to post 2 months of your expected accounts receivable, and to them that's just an insane ask, so they're not going to make you do that. But it just goes into the question of how come these things get stopped at certain levels and don't move further.
Yeah, well, even small, like I say air quote small. It's like, people forget that 10 megawatts, that's a lot of power, but like at 10 megawatts, are you talking a couple $1 million if you want to post 1 to 3 months of collateral for, like you said, accounts receivable. So yeah, that's interesting.
You'll have
Blake,
to
maybe
keep on investigate.
I know, I will. But maybe just to keep a pulse on the time, I want to be respectful of time here. Um, I would love to maybe kind of close out by asking, what are you excited about in terms of like the future of energy, Bitcoin mining? You kind of straddle both worlds with your job and what you're doing. What are you most excited about?
Well, I'm excited about a lot of things. I think the most interesting thing for me moving forward is how utilities are warming up to Bitcoin mining and actually putting forth a good faith effort to collaborate because they kind of have to at this point, right? ERCOT doesn't really have a choice but to
Yeah.
learn about Bitcoin mining, right? And to stand up a team, and I think it's beneficial I think it will be ultimately beneficial for the grid. I think it will ultimately be beneficial for, normal residential consumers of power to have kind of a base buyer of last resort that can help subsidize costs. But how we get from here to there is extremely interesting to me. And it's uh, I'm fortunate to see these things happening in real time at the ERCOT market, and so really looking forward to seeing what the next 2 to 7 years has for us.
Same here. Very excited about that. Well, Blake, this just we could keep going, which is why I said I got to keep a
We
tab on
could.
the time. So I'd love for you to maybe give a handoff, plug how the audience can either get in touch with yourself or Galaxy at large. Please, give a handoff here for the audience.
Sure. So Galaxy Digital is my company. Our Twitter handle is at Galaxy HQ. You can also find us on LinkedIn, and you can email me, blake.king@galaxy.com.
Awesome, Blake. We'll link to all of that in the show notes for the listeners so they can quickly access that. And I really appreciate the time. This was a phenomenal conversation, and I appreciate it. You take care, Blake.
Yep. Thanks, Ben.